Guys, today I want to break down a huge week in the American economy. On December 10th, the Federal Reserve cut the Fed funds rate by 25 basis points or a quarter of a percentage point. Now, that brings the new Fed funds rate right now down to a range between 3.5% and 3.75%. Now, the Fed also made several important changes to how they manage money behind the scenes, changes that will affect all of us as consumers and as investors. Now, before we go any deeper, let me ask you this. How do you feel about the Fed cutting rates right now? Do you think they're late? Or do you think the Fed is doing the right thing at the right time by cutting rates now? Drop your thoughts in the comments below. I want to know where you stand. Now, on top of all of that, the stock market had two very different reactions. One day of excitement and record highs, and the next day, it was a sharp pullback in the market, right? And to make the week even more interesting, you had three Fed members disagreeing with the rate cut, which is very rare. Okay. Plus, Federal Reserve Chair Jerome Powell, right now, he's basically a lame duck leader, right? With his term ending in just a few months, while President Trump is already interviewing his replacement. Now, we're also seeing the Federal Reserve officially ending QT, or quantitative tightening, and beginning to buy Treasury bills again. So let's break all of this down in plain English, okay? Now, first, let's make sure everybody understands exactly what the federal funds rate actually is, okay? The Fed funds rate is the interest rate that banks charge one another for overnight lending to each other. Okay. Banks lend and borrow money from each other every single day so that they have enough cash sitting in their accounts at the 12 Federal Reserve districts around the country. The Fed doesn't set one exact number for the Fed funds rate. The Fed sets a target range for the Fed funds rate. This Fed funds rate is important because it's really the foundation of almost every other interest rate in the economy right now. When the Fed raises or lowers this Fed funds rate, it doesn't just affect banks, right? It affects credit card interest that me and you pay, car loans that me and you pay, personal loans that me and you pay, right? It also affects adjustable rate mortgages. This Fed funds rate affects the interest that you earn on your regular savings account at your bank down the street, and it affects the interest you earn on your high yield savings account, right? And not to mention you have business loans that are affected. So think of it like this. Think of the Fed funds rate like the floor in your house. If the floor on one level of your house raises or drops, every other room in your house is going to shift a little bit, right? The Fed funds rate works the same way with money. When it gets raised or lowered, it affects everything else in terms of money in our economic system, right? The Fed also has two main jobs. One, keep inflation under control. And you'll hear the Fed talk about this as what they call price control. And then their second main job is to keep employment strong. And you'll hear the Fed talk about this when they call it maximum employment. So the Fed raises rates to cool off an overheated economy. And then the Fed turns around and cuts rates to support the economy when things are slowing down and they got to give the economy sort of a boost. And that's what we see right now. Now, what did the Fed do on December 10th? The Fed decided to cut the Fed funds rate, to lower it, to give the economy sort of a boost, right? They lowered it by only 25 basis points or a quarter of a percentage point. Now, this is a small cut, but it signals something very important. Here's what it signals. This small cut signals to me that the Fed believes the economy is cooling down. It's not collapsing, right? The Fed is trying to get inflation down without hurting jobs more than jobs have already been hurt, okay? Now, let me briefly explain who actually decides what the Fed funds rate is going to be. The decision to raise or lower the interest rates, the Fed funds rate, is made by the FOMC, which stands for the Federal Open Market Committee. Now, this group is made up of 7 Federal Reserve Board members, plus they bring in 5 presidents from the regional Federal Reserve banks. Now, this FOMC group, they meet 8 times a year to decide the direction of interest rates and how much money should be flowing through the economy right now. Now, let me say this. Inflation has come down a lot from where it was at its peak, really about 3 years ago, right? But it's still a long way away from the 2% goal that the Federal Reserve has been talking about for several years, right? Job growth has slowed down. We know that. And we've seen the unemployment rate go up recently, but the job market isn't just crashing out just yet. So the Fed is trying to sort of walk a tightrope here in what they're trying to make a decision to do right now with the Fed funds rate. Now, let's go further into something that is absolutely critical to the entire decision that the Fed just made about the Fed funds rate, and that is jobs. Now, if you want to understand why the Fed is cutting rates right now, this is the heart of it right here. The job market is slowing down, as I said, meaning that the job market is getting worse for workers, okay? Job openings have been falling steady for months, and hiring has slowed compared to the post-pandemic boom that we saw, right? And then you have employers who are becoming more and more cautious. Remember, businesses are always making decisions today looking forward. So when you see employers and businesses becoming more cautious about jobs, it's an indication that they see something on the horizon, and the Fed looks at that. That makes a big difference because we've seen layoffs happening. Now, we haven't seen layoffs skyrocketing in all industries, but layoffs are creeping up in certain industries. And then we see wage growth has also slowed down, meaning workers now have less extra money to spend on higher priced stuff. And so the Fed is very sensitive to all of these data points. When unemployment starts to go up, even just a little bit, the Fed pays super close attention to that. Why? Because rising unemployment can do what? It can reduce consumer spending. Less people have less money to spend. Also, rising unemployment can slow down economic growth in total, right? It's like a cycle. People lose confidence, people stop spending, people start losing jobs, and then companies start laying more people off, right? And all this pushes the economy closer to things like a recession or maybe even stagflation. And what is stagflation? Stagflation is sort of a difficult economic condition, guys. It's really based on three things happening at the same time when you're talking about stagflation. You have a stagnant economic growth. In other words, you have slow growth or no growth in the GDP, right? And then the second thing you have when you have stagflation is you have higher inflation, right? Rising prices. Then the third thing you have when you have stagflation is you have high unemployment, right? And so the Fed doesn't want this stagflation thing happening because all those factors are going to reduce people's purchasing power. And that's not something the Fed really wants. That's why the Fed right now is saying, hey, we need to boost this economy, lower the Fed funds rate, making money cheaper to borrow right now so we can incentivize people to go out and spend money. And this is why at the press conference, the Fed said more balanced is what we're looking at, a situation where everything is more balanced. Now, earlier this year, the big risk for the Fed was more and more possible inflation. But now the Fed is openly saying and admitting something new, that they see more risk of job weakening. And that's really important. When the Fed sees the job market softening up and weakening like it is right now, the Fed's playbook usually changes. The Fed usually stops raising the rates, which we've seen. Now they're lowering the rates, right? The Fed usually starts creating an economic environment where borrowing money, spending money, and investments are easier. That's what the environment they want to create when they see the possibility of the job market weakening and maybe stagflation on the horizon. That's what the Fed does. And that's what they're doing right now. All of this is to protect the labor market. This is exactly what we're seeing. Now, why does this matter for you? If the job market continues to cool off or slow down, people are going to see fewer raises at their jobs, right? Less bonuses on their job. Job switching from one job to another is going to become more difficult. Companies may slow down hiring. And so for you, it means big purchases like cars and homes and things like that, they're going to get delayed as people become a little more leery about the economic situation. This is also why consumers should really stay cautious right about now. Don't take on huge payments if you have an uncertain job, right? Matter of fact, you don't want to really take on huge payments anyway, unless it's on something that's going up in value. But it's also why investors should expect more volatility happening right now. The stock market, here's the deal. The stock market hates the idea of a weakening labor market. It ain't good for the stock market. So what we see here is this: the Fed cutting rates early to try to soften the landing of what they see coming up, right? And this is a key point. The Fed is cutting the Fed funds rate right now because they don't want the job market to fall apart in 6 months. Now, let's talk about the vote that was sort of odd, right? It was a rare 9-3 split vote in the FOMC on whether or not to lower rates by 1/4 of a percentage point or not. Okay, that's extremely rare for the Federal Reserve's Open Market Committee. Here's what happened. You had 2 members who voted against cutting the rates, and they pretty much said that inflation is still too high to cut rates. Because remember, cutting rates is oftentimes seen as inflationary, because when the Fed makes money cheaper to borrow, what do? People go out and borrow more. And when people borrow more and use more money, it usually sends the demand for goods and services higher. And what happens when demand goes up? Prices go up. So typically lowering rates is seen as an inflationary move. So there were 2 board members that said, no, inflation's still too high. And then you had 1 member who voted for a bigger cut, right? This member wanted a 1/2 of a percentage point or a 50 basis point cut. So inside the Fed, you basically have right now a group saying inflation is not done. We still have too high inflation. Don't cut the rates yet. Then you have another group saying, hey, the economy is slowing. Cut more right now. And then you have the majority of the FOMC saying, let's cut a little bit and then wait and see, evaluate some data, and maybe we'll cut again at our next meeting. So this level of disagreement tells me and you something really important. It tells us that the data is mixed, or the interpretation of the data is mixed. Nobody is completely sure where the economy is going next. Not even the people who study this thing for a living 10 hours a day know exactly where the economy is going next, right? When the Fed is split like this, it usually means we're at a turning point. Now, let's talk about what that turning point is. The turning point is really the big reset in the Fed's direction. Now, this is a reset that you need to know about it. I spoke about it last week on last week's video. It's the end of quantitative tightening, or QT. Now, real simple, QT is when the Federal Reserve slowly shrinks its balance sheet. They let the bonds that they bought to insert money into the economy, they let those bonds that they own mature and they don't replace them. They let those bonds just literally roll off their balance sheet. Now, what this does is this extracts or pulls money out of the financial system. Well, as of here in December, right now, the Fed officially ended QT. That means they're no longer shrinking that balance sheet on purpose. In other words, they're no longer pulling liquidity out of the economy, right? They don't see a need for that anymore. And they just started a couple of days ago. The Fed began buying about $40 billion per month in short-term treasuries. So the Fed is doing this to keep the banking systems filled with enough cash as they make cash cheaper and cheaper to borrow, right? The Fed calls that ample reserves, right? So the Fed uses, let me just explain it like this. The Fed uses electronic money out of thin air and uses that money to buy treasury bills, T-bills. They say this is, now the Fed has come out and said this is not QE, right? Quantitative easing. But at the end of the day, money is still money. Adding more short-term buying supports the financial system and keeps this machine running. They can say it's not quantitative easing, but it really is the opposite of quantitative tightening, right? So for everyday people, this means this. Banks can feel more comfortable lending money at this point. There's more liquidity in the system, or there's more money in the economy. So that means borrowing conditions may slowly improve coming up here, meaning money is going to be cheaper to borrow. And asset prices like your stocks and your real estate, they usually get a boost from this extra liquidity that the Fed pumps back into the economy. Now, how did the stock market react last week to this news that the Fed was lowering the Fed funds rate? The stock market had 2 very different reactions, right? The day after the celebration, right? The day after the rate cut, the S&P 500 and the Dow hit new record highs. Investors were celebrating the idea that the Fed is done with tightening the money and is cautiously supporting the growth by making money cheaper to borrow. Yay! But guess what? December 12th, or the next day, Friday, came the pullback, right? Things reversed. Stocks had their worst day in about 3 weeks on that day. The S&P 500 fell by what, about a little over 1% that day. The NASDAQ, which is tech heavy, dropped around 1.7%, right? You had major tech names like the Broadcoms and the NVIDIAs and the Oracles, right? The major tech companies were hit hard on Friday. But hear me out on this, guys. This is normal, okay? No need to panic or trip, right? After a big rally, a lot of investors in the big techs, they oftentimes sell their stocks and they take profits, right? Especially in these tech companies. So this was nothing to be alarmed about. But the big lesson is this: the stock market is emotional, right? The stock market reacts fast, but long-term investors like we want to be, our job is to stay steady, right? Let the stock market have its volatility. That's cool. We just want to stay in there and stay steady. Now, the other thing I want to hit on real quick is the political side of the Federal Reserve, okay? Jerome Powell's term as the Fed chair is going to end coming up in May of 2026. He may stay at the Fed in some other role somewhere, but his leadership over the Federal Reserve is going to end, right? Unless he's reappointed, but that ain't going to happen. We know that, right? President Trump is already interviewing his replacements as we speak, right? Some of the names being reported are basically people who may be more willing to cut rates more aggressively and take a more forward-looking approach than Jerome Powell did. See, Jerome Powell has been looked at as a Fed chair who has usually acted too cautiously and was too slow in making the right moves, because Jerome Powell's philosophy is very cautious and very data-driven. Remember, though, the data that the Fed uses to make decisions has a lag time. And so the data is usually a month behind. And so the Fed that we've had over the last several years has been making decisions based on data that was a little bit slow. And that's why really the Fed chair, Jerome Powell, right now, he's been given sort of the reputation of being a Fed chair that always reacted behind times, too slow, right? It's been part of his philosophy. So you need to stay aware, because if a new chair cuts rates faster and takes more risk and is more forward-looking as opposed to being data-driven, this economy could shift very quickly here at the beginning or middle of next year, right? So this is one of the most important things that investors should be watching as we move into 2026 and beyond. Now, let's talk briefly about tariffs. This year, the U.S. imposed new and higher tariffs on imports from places like China, Canada, and Mexico, right? Many of the experts warned, remember, guys, several months ago, the experts were warning us that tariffs would do what? Push inflation higher, much higher, and of course, slow down economic growth and possibly force the U.S. into a recession. But what has actually happened so far is a totally different thing. Tariffs have had an effect and raised prices slightly, only by maybe what they said 0.4% to 0.7% in terms of inflation. But that's really it at this point. So yeah, tariffs have had their share of cost, but they have not caused the kind of major economic calamity and damage that many people predicted and many people were telling us that they would. The economy is still growing. Unemployment is still fairly under control, fairly reasonable, and the stock market is near record highs. Now, this doesn't mean that tariffs don't matter, because they do matter, but it does mean that the U.S. has been resilient and has absorbed tariffs better than many people expected. And so it really makes it feel like that whole tariffs are going to ruin America talk was all just politics. Now, if I'm wrong about it, you let me know in the comments below, but tariffs haven't had the effect that everybody said they were going to have. Now, let's talk about what all of this means for everyday people like you and me. A 0.25% or a 25 basis point rate cut, it's not going to cause huge immediate changes for me and you. But over time, we're going to notice a few things. We're going to notice slightly lower credit card rates, right? If you have credit card debt, we're going to notice lower rates on our adjustable loans, or our HELOCs, right? Those home equity lines of credit. We're also going to notice slightly lower automobile loan rates and personal loan rates. Savings account rates may also drift down as well, as I mentioned before, right? And remember, the Fed is cutting the rates now because the job market is cooling. That means you don't have to take on huge new payments, right? Without thinking carefully through what you're doing, because the job market may continue to deteriorate. Keep building your emergency fund so you have a stash of cash. You don't want just 1 month's worth of emergency money. You want to have 6 months, 8 months, your decision. Stay ready in case hiring slows down. in 2026. Keep your resume handy, get the additional skills, get the additional certifications, the things that make you marketable in the workforce, right? Go ahead and get those things. And if you have a side hustle or side gig, go ahead and continue to work on that and build that up. And as an investor, keep investing, keep dollar cost averaging. Don't shift how you invest based on what's going on. You can just stay in there, right? As an investor, right? Some other things to think about as an investor. Short-term volatility could be your friend. The market is at all-time highs, but it's also going to have its sudden dips and sharp moves. Maybe you stay ready to actually buy some of the dips. Keep dollar cost averaging, but still buy some of the dips, right? And you know there will be dips, right? There's always dips, especially with QT ending, new Fed leadership coming up, rate cuts happening. All of this is creating uncertainty that adds to the possibility of volatility in the stock market. And tech. Keep in mind that if you're heavy in tech, tech normally has these pullbacks and slowdowns, right? More volatility in tech. So make sure you're not overly concentrated in one particular sector. Make sure you allocate and diversify your portfolio, right? There's a good chance you don't want to have 70% of your portfolio in one sector called tech. You want to spread that thing around. And don't forget about bonds as an investor. This is becoming a better environment for high quality bonds, better than it's been in a while. With the Fed funds rate now in the mid threes, bonds offer income and could rise in price if rate cuts continue into the early part of next year. And don't forget about one of my favorite investments, which is real estate, right? Mortgage rates may drift downward, but don't expect a return to pandemic era lows when the mortgage rates was 2% and 2.5%, right? Don't expect that, but just understand they may come down. Borrowers with adjustable rates may see them come down as well. But don't sleep on real estate as an investment. Now, things you need to watch. Who's going to be the next Fed chair? Will that next Fed chair be a more aggressive Fed chair than what we've had over the last several years? And you want to be thinking about whether the Fed's new Treasury bill buying stays small, or do they start to buy more and more T-bills? And of course, keep your eye on tariffs, right? Are tariffs going to actually make inflation go up or not? These are all factors that are going to shape the markets far more than just this little 25 basis point rate cut, although it's important, very important. So here's the bottom line, guys. The Fed cuts rates, and the Fed ended QT, and the Fed's buying short-term treasuries again, although they're not calling it QE, right? Will this lead to higher inflation again? We don't know. Will this lead to the economy getting the boost that they want? We don't know. And remember, the vote was split 9-3, which shows us there's some confusion at the top. Confusion amongst the FOMC, right? There's disagreement there. Jerome Powell, he's a lame duck leader because his term is going to be ending in a few months. And the new Fed chair could have a different approach, and that could really make a big difference in this whole thing. The stock market is bouncing between new highs and sharp pullbacks, right? Lots of volatility because you got tech at the top, and we know tech is volatile. And this is the moment, guys, when headlines are going to be loud. The reactions are going to be fast. You're going to see some panic here and there. And the future is sort of uncertain, right? But your specific personal financial success is still going to depend on the same things we always talk about. Staying focused, having a plan, being patient, staying disciplined, and not letting the headlines run your decisions. Let your personal philosophy and your core beliefs and your system and your strategy run your wallet, right? That's what we got to do. Stay the course. Guys, I hope you got value out of this quick video. Listen, if you want to take control over your money the right way, grab my new book, Manage Your Way to Millions, over at manageyourwaytomillions.com. It's also on Amazon. And check out my complete Smart Money Bro system over at smartmoneybro.com. And also, I got some free stuff for you in the description box below, so make sure you tap into that. Do me a favor, share this video with your people, your good people. Drop a comment below if you got value out of this video, okay? I want to hear from you. Remember, the best person who's going to take care of the old you is the young you. Until the next video, peace.